What's up, wonderful people? Welcome back to MoneyTalks, the Money Talks series, episode 14. So a long time ago, maybe a year ago, I made a video about the very basic investing principles called Principles 101. Investing Principles 101. Well, a year later, we're back with Investing Principles 202. So today I want to talk to you about three very basic investing principles to success that everything I've been talking about builds on. So without further ado, let's get to it. The three intermediate principles of investing. So some of you that have been following the channel from the very beginning, you're no longer rookies. Now you're in the big league. So I'm giving you all the intermediate knowledge to really up your game to the next level. The very first principle that you need to know is called asset allocation. Now, just as the name sounds like, it means that putting your investment into different baskets. So at a very basic level, let's say I hold a bunch of stocks. I think that I'm really smart. I can beat the market. I want to make sure that my stocks are diversified, so I might do that by picking different sectors like energy, like consumer defense, like industrials, like REITs, and then mixing them all up in order to make sure that my stocks are allocated accordingly. But that's just diversification. Asset allocation, it's a little bit deeper than that. It means holding different asset classes. So what do I mean by different asset classes? Well, so in addition to my stocks, I'll be adding in other investments like bonds. I would be adding in maybe some cryptocurrencies. Wait, hold up, cryptocurrencies, isn't that too risky? Well, it really depends, but you have to do your own research. But there are safer ways to allocate your assets in different classes. You can go with physical gold bullions, also silver, or you can hold funds that hold these commodities such as silver and gold funds. Other asset classes that I just talked about last episode would be real estate in addition to stocks. So the key here is not to just have a single asset class, but to mix them all up in order to make sure that when one is going down, you have something else that's going up in order to make sure your portfolio is balanced and your risk is diversified. The second intermediate tip I wanted to talk to you about is called DCA. Now, what on earth is DCA? Is that like a Marvel superhero or something? No, it's just stands for dollar cost averaging. I'm not going to get into the nitty-gritty of the numbers because some of you might not like math. If you want an actual example, you can look on my blog at tahmidtalks.blogspot.ca or .com. The link is down below. And other than that, there's also tons of example online on blogs that will explain what DCA is. But the bottom line is with DCA, you're basically spreading out your money into investments over time. So instead of putting in a lump sum before, God forbid, a market crash like we saw recently, DCA would make sure that you buy at a good average price, and over the long term, you're buying more when the price is low and you buy less when the price of the underlying asset is higher. At the end of the day, it should all work out mathematically to your advantage. The third and final principle I wanted to talk to you about today, it's a little bit deeper. Welcome to Philosopher's Corner, where we talk about the big issues. It's called wealth preservation. Now, if you watch my channel, that I never suggest that following these tips will help you get rich quick. That's not what we're here for. You want to get rich slow. A lot of the reasons we invest in these asset classes is so we get steady returns. Even if you can generate 7-8% annually, over time that really adds up to a big sum. But the idea of preservation is that there's something called inflation. And every year in a developed economy, inflation is give or take 2 or 3% on average. So if you had $100 last year, this year it would buy you $98 worth of goods at 2% inflation. So your money is basically losing value over time. What being invested helps you do, instead of keeping cash underneath your mattress, is that it helps you make sure you retain the value of your money even with forces such as inflation. So even if you get a measly 2-3% a year, at least your money is not losing value, it's preserving its value. And that's great, because if you remember my very first episode of the Money Talks series, I talk about improving your skill sets, getting that higher income, getting to the bag, and making sure you're improving yourself, because you are the best asset that you have. And all that money that you're attaining using your skill sets, you want to preserve the value of that even if it's not growing. So that means wealth preservation is the motive. Major key. So there you have it, folks. I hope these 3 intermediate tips that this whole series is about you keep in mind, and as you go forward, become mature investors, you put these 3 to the test. So once again, to recap, number 1 was asset allocation, number 2 was DCA, dollar cost averaging, and number 3, the motive, was wealth preservation. Thank you all for joining me for episode 14 of the Money Talks series. Please do leave a comment, like, and subscribe. I hope to see you next week as we talk about debt management. Very serious issue for a lot of people. Peace for now.